Hello, everyone. Welcome to what promises to be a really exciting webinar. Thank you for making time to join us. Appreciate you taking time to join what I think is will be a really good conversation. We're very happy to have Natasha be our speaker today. As you come in, you all know we are a very Pan-African community. Can you please use the chat to put in your name, your organization, and which city you're dialing in from, so we can just get to appreciate how far and wide a community we are part of. This impact community is growing quite extensively on the continent at the moment. So if you can please put in your name, your organization, and which city or country you're dialing in from, that would be really awesome. Thank you, everyone. It's nice to see people that we haven't been in touch with for a while. COVID kind of made us a bit of a recluse community, but it's nice to see people here. Rihanna, nice to see you. It's been a while. Thank you so much for making time to be with us today. Bridget, nice to see you. Vuiswa, nice to see you. Really good to see some familiar names on here. So please put in your name, your organization, and which city you're dialing in from. This promises to be a really exciting conversation for all of us to be part of today. Thank you, Jasper. Nice to see you. It's been a while. It's great to see everyone. Janet from Tanzania, thank you for joining us. Hey, Jack from Cambridge. Good, thank you for making time. We are truly plugging into a very broad network of people. So thank you for everyone making time to join us today. Saline from Nairobi, nice to see you. Christian, one of our partners from Boringa, nice to have you on. Eugene, Global Innovation Fund, thank you for making time. Right, Abu, I think let's get cracking because there's some really exciting stuff coming in from Natasha. I'd love to spare as much time for her to spend speaking to the audience, so we can also engage the audience in a question and answer session after that. So welcome. This is a really exciting series that aligns very much to our mission at AVPA of mobilizing capital for impact and ensuring that the capital is deployed for maximum possible impact. Today, we want to talk about the role of Catalytic Capital and the role of impact-linked finance in mobilizing private capital for impact in Africa. This is a really interesting part of the whole innovative financing space. And fundamentally, if you ask yourself why we're talking about the role of private capital in impact, this continent's development agenda and financing has largely been built around funding either by governments, philanthropists, or the aid community. We all have seen what has happened to aid in the last couple of months and couple of years, actually, through Trump's last few years as US president, and he cut USAID budgets. And also the UK government in the last couple of months has cut back its budget, aid budget globally, from 0.7 to 0.5% of their GDP, and that's on a shrinking COVID-affected GDP. So as Africans, we've got to start thinking very differently about how do we mobilize capital for impact. Our resources are far outstripped by the demand that we have for projects and work and problems to solve. So if you think about the other options of where we can source capital from, private markets and capital markets become the place for us to look at. Capital markets on their own have something like $250 trillion globally. The SDG financing gap annually in Africa is between $500 billion to $1.2 trillion annually between now and 2030. And that was a pre-COVID number. It is said that in 2020 alone, COVID added another $1.7 trillion over and above the $2.5 trillion needed globally to address the SDG financing gap. So it's a really tough time for the world in terms of mobilizing capital for impact, but also a really great opportunity for us to be looking at more innovative ways to engage the private sector and tap in the private sector as a potential source of capital. These challenges are some of our paradigms where we need to start looking at profit and purpose not being mutually exclusive. We can do well as we do good. And also for those of us who've been in the development space for a long time, to not consider the development financing to only be grant linked. There's a lot of the solutions that are offered in the development space that have some commercial value, which, if well exploited, can offer affordable services, but around a more sustainable market-based solution and model. So this is part of the conversation we're going to be having. Abu, if you go to the next slide, and as AVPA, there's some really interesting things we want to talk to you about that will be coming up as we look at this space. We are going to be engaging a lot deeper into this subject in the next couple of weeks. We're partnering with a group of US investors to talk about the opportunity behind catalytic pooled funds. We ask you to keep an eye on that announcement that will be going out pretty soon. We're going to be looking at some sector-specific catalytic pooled funds, where we are aggregating catalytic funds from multiple donors to see if we can produce a consistent and large pipeline of investable impact opportunities from Africa that can then be served and scaled through mainstream capital. We're super excited about the second point there, the Catalytic Capital Capacity Building Program. We just got a grant, which will make a formal announcement in the next couple of days, to build a training program on catalytic capital investing. This program activities will kick off in September, and we're super excited about playing a leading role in enhancing the concept of catalytic capital investment into Africa and growing the capabilities of our social investors to be active players in this space. On the third point there, many of you know we ran the Impact Investing Fellowship Program last year. It proved to be a real success. We had 61 fellows join the program, 31 African and 30 Asian. This year we're running the program, and because of the huge demand that we had from Africans, we're going to run an African, well, not only an African-only program, but fundamentally taking close to 60 fellows, mainly from Africa. And we'll keep an open mind about taking people who are investing in Africa from other parts of the world. So that program, you'll remember, was offered by faculty from the Oxford Side Business School. So we're super excited that we'll be running the program again this year. And then the last thing I wanted to just highlight is on the back of that Impact Investing Fellowship Program, in collaboration with Ashok and Boehringer Ingelheim, we are partnering to establish another impact investing leadership funders forum focused just on the healthcare vertical. This will be kicking off in September and has graciously been funded by Boehringer Ingelheim as part of their Making More Health initiative. We're super excited to be partnering with Ashok and Boehringer on this program. And please, those of you who are in healthcare and would like to be part of this program, we're going to start activities for it fairly soon, and the program should kick off in September as well. If you're interested in any of these programs, 1, 2, 3, or 4 as named above, please send us an email or contact us on info@avpa.africa, or find any of us in one form or another. I'll put my email address in the chat, and we'll repeat this email address in the chat as well. But I don't want to take up any more time. There's a lot of exciting stuff coming up to help build this ecosystem and the community. I always say that Africa is the sandbox for impact. We are truly blessed to be in this continent where a lot of our challenges are now exciting impact opportunities. So I want to welcome Natasha, who's worked with us for many years and is a real knowledgeable person in this space, to talk to us about this particular topic. Natasha, over to you.
Fantastic. Thanks, Frank. Thanks so much for having me. It is always a pleasure to be part of the AVPA community. So delighted to be back, and really looking forward to this discussion today. It's one that's very close to my heart. So grateful to have the opportunity. So before we kick off, a little bit about who I am. My name is Natasha Dinham. I lead the advisory and executive education team at Roots of Impact. And sorry, before I do this, Frank, can you just confirm that you are seeing the right screen that I am sharing, and not my WhatsApps, which is always a fun way to start a presentation?
Yes, all good, Natasha, all good. You can proceed.
All right, fantastic. So I lead the advisory and executive education team at Roots of Impact, and I'll be telling you a whole lot more about what Roots of Impact is and what we do over the course of the next 20 minutes or so. I'm particularly passionate about this space and have been in the space for just over the last decade. And my experience is predominantly around designing, launching, and managing impact funds, particularly those with an outcomes and an impact focus, and working directly with impact enterprises. I've had the opportunity to train fund managers on impact investing and advise financial institutions on how to build their impact strategies. And I've been very fortunate to have the opportunity to sit on a number of advisory boards of and investment committees of SME funds and TA committees to really get a sense of what the biggest challenges are, not just from the SME side, but from the investor side as well, and try to really get a grasp of how we can bring those two together in terms of creating solutions that really catalyze impact. I am very passionate about ecosystem building. I love opportunities like this where I get to talk to the rest of the ecosystem. I for a little while managed the secretariat for the National Advisory Board for Impact Investing in South Africa, where I was when I was the lead at the Bertha Center. And now very happy to be working within the space of impact-linked finance that I really feel is the future as we catalyze more impact. So talk a little bit about what impact-linked finance is and how that ties into Catalytic Capital. And at Roots of Impact, our starting point is bringing the most effective type of finance to impact enterprises. To achieve this, we've observed a common challenge that most of the world's impact enterprises are faced with. More than 80% of impact enterprises that are serving the world's most vulnerable have this in common. They're not operating at or near scale, and they're not ready to take on investment. And I know, having seen the audience today, that I'm not telling any of you anything that you don't already know. The real question is, what do we do about it? So a lot of this stems from the lack of relevant capital for enterprises who are at this stage in their business cycle. From an investor's perspective, these businesses fall below the efficient investment frontier. That means that the set of investments that are expected to provide the highest returns for a given level of risk. And impact enterprises at this stage are often seen by investors to be too high risk for the level of return that they offer. And so they struggle to attract investment. And obviously they need investment if they're going to scale and grow their impact. So for impact enterprises particularly, this phase is also the critical stage of their impact journey, not just their business journey, but their impact journey. And if they had the right support here, they'd be positioned to create exponential direct and indirect impact, as we can see there. But most of them don't survive. And we have a lot of names for this gap, the missing middle and a number of other names. But really this critical stage that they don't make it through, where if we could nudge them through this, the amount of impact that they would create directly and indirectly would be substantial. So I've got a poll question here, and it's an open question to the audience. What proportion of institutional impacted investors do you think are willing to sacrifice financial returns for higher levels of impact? And so we're gonna leave this poll open for a couple of seconds, just to give you an opportunity to share where you think on the spectrum. And I know a lot of people already have a very good idea of this. What proportion of institutional impact investors are willing to sacrifice financial returns for higher levels of impact? And I should say willing and able, because investors act on behalf of whoever they get their funding from. And a lot of institutional impact investors don't have this flexibility. But it is interesting to see. And we've got a nice number of answers coming through here. I'm just going to give it a few more seconds if you want to throw your hat into the ring on the proportion of institutional impact investors who will sacrifice financial returns for impact. Okay, we've got quite a lot of answers here, so I think we can end the poll. I actually don't see the results. Frank or Abu, can you guys see the results?
Abby, they're coming right up.
Okay, well, not critical. Yeah, I see they should be sharing, but I'm afraid I'm not seeing them. That's okay. We have the answer here, and you can see how right you were. The answer is that it's less than 20% overall. 15%, according to the excuse me, according to the GIN, only 15% of impact investors target below market rate returns that are closer to capital preservation. We should say a further 18% target below market rate returns that are close to market rates. But by far the majority, almost 70%, want to get market rate returns. And just to point out, this is not a criticism of impact investors by any means, but it's a realization that impact investing isn't the utopia win-win-win that it's sometimes portrayed to be. We do have to remember that for a lot of investors, there just isn't the flexibility to be able to sacrifice returns in exchange for impact. And in many cases, this is something that is needed if we want to hit impact across all levels. So one of the biggest reasons for this is that investors don't and can't price social value when evaluating impact enterprises. So impact enterprises are viewed on their financial value and their propensity for their probability for growth, their financial projections, but not on the social value that they bring. So for enterprises who are targeting low income, hard to reach populations, they may have smaller margins than those targeting middle or upper income populations. And at the missing middle stage of an enterprise's life, this means that they're going to be left with this commercial viability gap, which is often the reason that they're not able to access the capital they need to grow and scale. And if they want to, they may often be pushed, if they want to access this capital, they may be pushed to move upstream and change their focus. So instead of focusing on the lowest income, hardest to reach populations, be nudged upstream. And we really don't want to see that happen as a result of the need for accessing finance. So how do we bridge this gap between investors' expectations and their needs to get close to market rate returns and the reality that high impact enterprises face, which is that often they're not hitting the same commercial viability targets that are required? One way to achieve this is to bring in other forms of funding from public and philanthropic funders. And this funding that comes in from public and philanthropic funders does put a value on social and environmental benefits. So if we bring together this public and philanthropic funding that does price in social and environmental benefits, and we put this together with investors funding, we can maximize the amount of impact that's created with the capital we have. And this is known as blended finance or catalytic capital. And it uses philanthropic or public capital, that's the one in red on the slide here, to mobilize private sector capital for social good, unlocking this private sector capital. And the concept of blended finance and catalytic capital has grown substantially in the last few years and has really gained traction in demonstrating how we can use public and philanthropic funding to unlock private sector capital. So if we go back to our efficient investment frontier, blended finance either increases the return or decreases the risk that's associated with impact investment, or both. It can do both. And in doing so, it pushes target enterprises onto the efficient frontier and solves a lot of the issues that we had with them being able to access capital. However, we need to acknowledge that blended finance doesn't solve all of the challenges that are faced by impact enterprises. what we've seen from the data is that only 10% of blended finance is going to supporting investments in the least developed and low income countries. To date, a lot of the blended finance transactions are still happening at large deal sizes and in middle and high income countries. And blended finance is typically designed around the needs of funders, not around the needs of enterprises. So often when we design blended finance and we see designs of blended finance structures, they're focused on the investors and the funders' needs, but they don't necessarily start from the perspective of the enterprise and build a structure around that. And impact isn't embedded by design. So although we're bringing together different types of capital to achieve impact, very, very few blended finance structures actually tie the impact to the finance itself. And this is where we see a gap. So at Roots of Impact, we asked, we asked ourselves a very simple question. What would happen if social returns were what really mattered? So what if there was a way that we could quantify and monetize the impact that these businesses are creating? And then if we could give that value that they were creating back to them to cover that commercial viability gap that we saw before. If we could do this, we could get rid of the tensions that enterprises face between their commercial goals and their impact goals, and we could essentially correct for the mispricing in the market by pricing in the impact that these enterprises are creating. So we created an instrument that does exactly that. It's a very simple instrument called a social impact incentive, or a SINC. And we've piloted over 20 of these across the world in impact sectors, including healthcare, off-grid energy, wash, agriculture, education, employment, circular economy, and fintech and gender inclusion, which is one of the big ones we're about to kick off now. We found that this model works in, as you can see, multiple different sectors, multiple different geographies, and really works on a very, very simple premise. If we can price in the value of the social good created, then a SINC will provide an additional revenue stream that improves the profitability of the enterprise. And while it does that, it also improves the risk return profile to investors, making it easier for the enterprise to attract the investment that it needs to grow and scale and survive that critical phase before it scales up its impact. So we're essentially nudging up the total revenues by providing payments that are tied to social outcomes. In practice, it's a very simple structure. We've got an outcomes payer, and the outcomes payer is a public or philanthropic funder who provides payment for social outcomes that are achieved by the enterprise. And then this is a bilateral contract between the impact enterprise and the outcomes payer. And then the impact enterprise is able to use this additional revenue stream from the SINC to catalyze investment funding, to get investment from an investor, and in doing so, grow, scale their business and scale their impact. So here's what we're aiming to see in terms of impact growth. We bring in a SINC at a point in time, and with the additional revenue stream and the catalyzed investment is also very important. Not only does the impact enterprise survive the missing middle value of death, the scale it gains catapults its impact so that it's achieving a whole lot more additional impact than it would have without. And this additionality in terms of achieving things that wouldn't have been achieved otherwise is very, very important. So in the interest of time, I'm going to go through this quite quickly to leave enough time for us to engage and have a conversation about this, because these kind of conversations are always more fun if we're talking to one another rather than just me talking to you. But I'm going to give you an example of our very first, one of our very first SINC transactions. And this was done with an organization called Clínicas del Azúcar, which is based in Mexico. where diabetes is the leading cause of death, and less than 10% of the population have access to specialized healthcare. Now, the founder of Clínicas del Azúcar, his name is Javier, and his mom had diabetes and really struggled to manage the disease, even with private insurance and specialized healthcare. And he thought, gosh, if they were struggling with private insurance, how on earth were people without managing to make this work? So they wanted to provide very high quality diabetes care at just 40% of the average price for treatment, which was quite an ambitious impact goal. And doing so while maintaining a sustainable business model and attracting capital from investors was really challenging. So here's what we did. We designed the social impact incentive. We based it on two key metrics. The metrics that we were focusing on was firstly a higher number of low-income patients who were accessing quality treatment, and many for the first time. So we wanted to support Clínicas del Azúcar in reaching patients who otherwise wouldn't have access to this sort of care. And then secondly, we wanted to make sure that the treatment that they received actually resulted in positive health outcomes. So we monitored the improvements in their blood sugar levels to make sure that this was actually resulting in something tangible in terms of health outcomes. During the time of the sync, they raised 1.5 million in private sector investment, and at the end of the sync raised another 6 million. So in total, 7.5 million in private sector investment, which also allowed them to scale. This case study is available on our website, so I'm not going to spend too much time, but it just to show what happened, because this was one of the first ones we did. So we've got a really great overview of how it ended up affecting the business. We had a very strong demonstration of bottom of the pyramid penetration. There was health improvement, and importantly, they were keeping the focus on the most underserved while ensuring high quality treatment. So now we have numerous examples, successful examples of sync up and running around the world. So we asked ourselves, what would happen if we could price the social value that an impact enterprise creates directly into its investment contract? So in the sync, there's two parts to it. There's the outcomes funding, and then there's the investment. And we said, what if we just put all those together in one single contract, so that it's all in the terms are all combined. And so instead of having a sync and an associated capital raise, we did it in all in one go. So we're essentially rewarding impact and catalyzing scale at the same time. And so this is where we developed this concept called impact-linked finance. And impact-linked finance is a full range of financial solutions that links rewards to the achievement of outcomes. It sits at the heart of impact investing, of blended finance and results-based finance, and it brings together the best elements of all three. So just as an example, this is what an impact-linked finance transaction can look like. And Frank, I see you're on my screen, which means I'm running out of time. I just have 2 more slides after this, so I'm almost done. An impact-linked loan is a loan or a note, an investment that is tied to the amount of impact that's created. And when we talk about impact created, we measure outcomes. So the enterprise repays the note with interest. However, the more social outcomes they create, the higher the social outcomes that they create, the lower the interest rate that they have to pay back. And this repayment can even be negative. So they're not getting a payment or an additional revenue stream like with a sync, but they're getting rewarded for the outcomes that they create embedded into the actual terms of their investment contract. And it's built into one investment contract, which also helps them scale and grow their impact. So we've got a whole bunch of resources on our website around design principles that ensure that the impact is targeted and rewarded. I won't run through all of them now, but you're welcome to take a look at our website. They're all there. And then this is an overview of some of the live funds that we have at the moment. We've got an impact-linked fund for education, which is specifically focused on West Africa and MENA. We are launching next week an impact-linked fund for gender-inclusive fintech, also with a particular focus on Africa. And then we've got an impact-linked fund for Eastern and Southern Africa, which we've made a number of transactions into now and are at the process of contracting. And we're hoping to launch an impact-linked fund for WASH in the next month or so. So do keep an eye on our website and our LinkedIn if you'd like to get involved in any of those. Great, thanks so much.
Thank you, Natasha. Thank you very much for that presentation. To the audience, if you have any questions, please put them in the chat. We'll try to get to as many of them as possible. Natasha, this sounds very logical, especially when we are looking to test new models for scaling proven programs. Why isn't this done more extensively? Why aren't we seeing the uptake of this kind of impact-linked financing done more extensively? What have you guys found?
Great question, Frank, and I'm a little bit biased in my answer because I think it should. I think there should be much more uptake of this. I think that it's having spent so many years in the impact investing space and seeing these challenges come up again and again. When we talk about impact investing, the fact that we aren't tying the investment to the impact just is a bit of an oversight, in my opinion. And so I really feel like we were chatting about this yesterday, you know, is Africa ready for impact-linked finance? Yes, I feel like we have never been more ready. We all know, everyone in this room, well, I've had a number of conversations with people in this room about the challenges that these enterprises face and the trade-offs that they have to make and the ability to catalyze capital. And so for me, it really does feel like a no-brainer that this is the next logical step in terms of impact investing. Let's tie the investment to the impact.
Okay, and from your experience, do you find certain types of projects or sectors lend themselves better to this kind of investing, or is it very much opportunity based?
What we have found is that it makes sense to run funds that are sector focused, which is why you'll see we have a fund for WASH and a fund for education and a fund for gender inclusive fintech, because there are a lot of synergies within sectors that we can exploit and we can benefit from. However, the underlying principle of tying impact to finance, we have not found a sector so far that it doesn't work in. It works across all sectors. Some sectors are particularly well placed for it. One of the things that we've learned is that if you're going to tie impact to finance in any way, shape, or form, it's very important that you are measuring the impact correctly, measuring and verifying the impact correctly. So sectors in which this is easier to do, particularly, for instance, tech-based sectors where we've got an abundance of data, that makes it a lot easier to structure these sort of transactions where we've got readily available data. But in terms of the effectiveness, in terms of creating positive outcomes, it's something that works across all sectors.
Okay. The one thing you possibly didn't mention or speak to the risks that potentially could come in doing some of this. You want to speak a bit about what are some of the risks you need to you pay attention to when you're designing sync deals?
Yeah, I think there's I maybe won't talk about it from the risk perspective so much, but from the challenge perspective, there are a number of challenges in terms of designing the structure really intentionally. If we're going to tie finance to outcomes, first of all, we want to make it simple and understandable so that it's easy to implement. We don't want to design something that's incredibly complex that just ends up being a burden on the enterprise. But in doing this, creating simplicity is often easier said than done. So we've got a number of ways that we do this. And one of them is we're very selective about the outcomes and the metrics that we select, but we really need to be intentional about how we choose those to make sure that we're incentivizing the right things, that these things are measurable, that they're achievable, and that they're pushing the enterprise beyond what they would do normally. So it's really, really key to us that additionality is embedded into each deal. So this shouldn't be just subsidizing things that would have happened anyway. We want to be able to, either on the financial additionality side or the impact additionality side, make sure that we're nudging enterprises into achieving things, like I said, either on the impact side or on the catalyzing finance side, that they wouldn't be able to achieve otherwise. So there's a lot of tailoring and a lot of in-depth conversations that happen with us in the enterprise, and this is not something that we do as a light touch thing and roll out across multiple enterprises at the same time. We really do work on a one-on-one basis, and I think that comes with a cost of knowing that is going to require a lot of effort.
Okay, so I'll come back to a question by Ashley that ties into measurement, but before I get there, some people think that any investment made in Africa is an impact investment. What's your thought about that?
Yeah, I think that's an interesting one, Frank, and it's a conversation that, or an argument that I saw kind of 5 years ago, and I think that the impact investing space has grown so much beyond that we can no longer be using that argument. Impact investments need to consider both the positive and the negative impacts that they are having, and regardless of where they are in the world, they really need to be intentional. So while definitely the potential for a positive impact in Africa is big, simply classifying all investments into Africa as impact investing doesn't work. We really need to be much more intentional about how we do that and what additionality we're creating as impact investors when that happens.
So in essence, what you're saying is a job created in a rural village is much more valuable from an impact perspective than a job created in a city, which probably would have been created anyway. Exactly.
So there's a huge additionality aspect here. And I think this is why for me, impacting finance makes so much sense, because it's much harder to create a job in a rural village where there are less access to markets, access to infrastructure. So to assume that we're doing the same thing in the two different contexts is really massive oversimplification, and that's not taking into account the potential negative effects that we could be having. So I think that we, as impact investors, we need to be a lot more aware of what we're doing, rather than just assuming that all funding that comes into Africa is going to create a positive impact.
Okay, fantastic. So Ashley asked a question that's tied to the sync model. Is the measurement done by an independent third party? Just I think what she's looking for is there checks and balances?
Great question, Ashley. And so like I said, as soon as you're tying finance to impact, to impact, as soon as you're gonna release a payment that's based on outcomes created, we need to be 100% sure that those outcomes have been created. And to do that, the kind of gold standard is independent third-party verification. There may be cases where we've got really rigorous data that is collected independently that's convincing enough. But as a standard, we always use independent third parties to make sure that everything is transparent and clear.
Okay, someone sent me a question seeking a bit of clarity. When you look at all of these like sync models or impact-linked financing models, there's a particularly significant role for grants and grant makers in making all these models work. Can you please talk to us a bit about what that looks like, and how can grant makers in Africa really plug into these kind of models to magnify and create impact and crowding private capital into this space?
It's such a good question. So the sync is built on the assumption that we have an outcomes funder who is a grant provider. and whether that's public funding or philanthropic funding, the sync model was designed with that outcomes funder in mind. And I think it's an absolutely critical piece of the puzzle here to make it work, especially when we look at the number of impact investors who are able to provide concessionary returns. We know there are not that many of them. And so that gap needs to be filled by public and philanthropic funding. I think what's really key here is that the grants that are provided in an impact-linked finance deal, first of all, they leverage so much more in terms of capital because they're leveraging private sector capital, they're catalyzing scale of the businesses. But secondly, they're only used when the impact is created. So because they're paid on outcomes, it's a very, very effective way for grant funders to know that they're getting the impact that they want to create. So rather than kind of throwing money in a direction and saying, I hope it goes well, it's saying, come back to me once it has gone well and we'll make payment for that. So it's a very powerful tool for grant funders to be able to make sure that they're getting bang for their buck when it comes to grant and philanthropic funding.
So if you think about that, I mean, how interesting would it be if government funding was given on that basis? I mean, we look at all we face in terms of lack of satisfaction with service provision and a lot of things around aid funding that's just gone to waste. Do you think governments could put better use of their money if they looked at some of these more innovative models of funding?
Absolutely, absolutely. I also recognize that that it's not, in terms of government funding, there's a lot of what we're talking about here is creating impact and then having that be reimbursed. There are a lot of, when it comes to nonprofit and public goods, where funding is needed upfront. And so this, there's a strong argument for not doing everything as impact-linked finance. But having said that, when you're working with commercial players who are social enterprises who are looking to be market ready, having government as a potential outcomes funder makes a lot of sense. And a lot of the partners that we work with are some sort of government agencies, not necessarily government themselves, but government agencies who bring this sort of funding to the table. And obviously this is also not something that we were the first people to think of. If you think about social impact bonds and pay for success models, there's a lot of this rationale for tying government funding to things that have been proven to work. They just work differently in different cases. So social impact bonds are really focused on more nonprofit type of endeavors. Impact-linked finance is really focused on catalyzing private sector investment for market-based organizations.
Okay, so Rai is working on scaling what I think is a sexual and reproductive health development impact bond in Kenya, and is struggling to find outcome funders. It says upfront investors aren't hard to find, but outcome funders are the challenge. How best should impact projects be positioned to attract outcome funders?
It's a great question, Sarai, and I think we empathize. The outcomes funders are difficult to find, and a lot of people ask me, how do you convince investors to get on board? And honestly, investors are the easy part for them. If they're looking for impact and positive financial returns, what we're doing is offering them that plus tying that to impact with an outcomes funder. Outcomes funders are definitely much harder to find. I don't think we've found a sort of silver bullet in terms of making it work. One of the things that we tend to do is work at a sectoral level and at scale, and so try to leverage partnerships between outcomes funders so that we can get multiple outcomes funders to work on a single goal. But I have to confess, we also don't have the golden answer there.
Yeah, Celine asks, in testing the sync model across various business areas, did you consider the extraneous factors that might have positively or negatively impacted the findings, or did we assume all other internal and external factors were stable?
No, so we try not to make assumptions. We work very closely with the businesses, and it's a very kind of time-intensive process of understanding their business model, understanding their impact goals. And so we don't rely on assumptions when we're building things up. We work from a very bottom-up approach. So there's a lot of engagement that happens. We look at the specific contextual factors. We don't assume that a sync that works with a company that does X in this context is going to look at the same as an exactly the same company in a different context. We need to start from base principles and work upwards, and that means talking to the entrepreneurs and really understanding where they're coming from. Okay.
One of the real benefits around this particular model where you're applying catalytic capital is the leverage you're able to bring in from the private sector. Is bigger leverage better all the time?
I love this question, Frank. So I think one of the biggest mistakes that we make in this industry is confusing leverage, capital leverage, with additionality. And we conflate this idea that if I put in $100,000 and I manage to leverage 20 million, well then of private sector capital, I must be super successful because look how much private sector capital I have generated. And I think that this is obviously we want to catalyze private sector capital, but more is not always better. In fact, in a lot of cases, and if you're putting in 100,000 and you're generating 20 million, what that shows is that your 100,000 probably wasn't needed in the first place, because if you were able to get 20 million off 100,000, then they probably would have come in without you. So I think the key here is not to focus on the number of the catalyzing leverage number, but rather to focus on the additionality. So would those investors have come in anyway? On the financial additionality side, and also on the impact additionality side, how much additional impact is being created as a result of the 100,000 that is then leveraged. So let's not conflate additionality with leverage. I think it's a very key point in this space.
Okay. David, UNDP asks, very appreciative of your presentation, and grateful for the overview of the sync. Is a concept similar to social or development impact bonds? And also, how do you decide on what specific outcomes to focus on, and how do you define thresholds as well as measure them?
I'm going to start with the first question first, David. Great question. We do get this question a lot. So there's some key differences in terms of SIBs and DIBs and syncs. The primary difference is that SIBs and DIBs are focused on government and nonprofit interventions, whereas we're focusing on businesses. SIBs and DIBs tend to focus on prevention measures or cost savings and proof of concepts, whereas syncs tend to focus on innovative solutions for impact and scale. With a SIB, we've got that investors carry the impact risk, and it's often all or nothing. With a sync, we share that impact risk between the investors and the enterprises. The theory of change, the overall kind of what are we trying to do with a SIB is SIBs aim to de-risk testing and rollout of innovative service delivery models by predominantly nonprofit entities. Whereas with a sync, what we're aiming to do here is mobilize larger private sector capital investment towards those high impact enterprises and create the impact there. So similar kind of, there's a lot of similarities between the two, but some fundamental differences as well on the SIB and DIB. But as I said, so impact linked finance was inspired by a lot of the cool things, innovative things that were happening already, and then just tailored specifically to market rate scalable enterprises. And then coming to the second part of your question, how do you decide on what specific outcomes to focus on, and how do you define thresholds and measure them? Excellent question. We do that on a case-by-case basis, working with each enterprise. We look, when we talk about which outcomes to focus on, we aim at a couple of key things here. So one, what's going to be additional? So what's being achieved already and what can be achieved further? What is the enterprise already doing and measuring that we can leverage off? What are the impact goals of the enterprise? So we really don't want to come in and create complete mission drift. So we want to make sure that we're aligning with the impact that they want to create. And then importantly, we want to make sure that as much as possible, we're measuring outcomes and not outputs. Obviously, this is not always possible, but we want to see the change that these businesses have on people's lives, rather than just the number of lives that they're reaching. And of course, all of this we want to do in a simple and concise way, which is a lot harder than it sounds. And so it's a lot of discussion with the enterprise to really understand what their needs are and build up an incentive structure from there based on additionality, and really nudging them to achieve what's in line with their impact goals.
You know, as you speak through this, one of the questions we get a lot is the trade-offs making all these impact investing decisions between profit and purpose. Do you think they're mutually exclusive? Are you seeing increasing models where we can do well and do good at the same time? And is that now an asset class that we think we can actively pursue and promote on the continent?
So when the concept of impact investing first came around, I was super excited about this. And I spent a lot of time convincing people that there was no trade-off needed, that we can, if you invest in climate change, you're going to do great stuff for the planet, you're going to get market rate returns. And that is true for many, many investments. It is possible to have impact and to achieve market rate returns, and there's no trade-off needed. However, for all of those investments, there are a whole bunch for which a trade-off is needed. And this is particularly when we're thinking of enterprises who are reaching the hardest to reach populations in the most rural areas, with the most underserved markets. It's just, unfortunately, we're never going to be able to hit market rate returns with those sort of investments when it's really difficult to do. And so there is absolutely a spectrum. And the further away you get from the, invest in clean energy and have a market rate return, the harder it is to make the model work. And I think that's one of the places that impact-linked finance comes in strongly. But the counter argument to that is that even on those investments where you can have where you can reach market rate return without doing anything differently to a normal investment, there's the potential to create more impact. And I think that if we're going to call ourselves impact investors, we should be doing either one of those two things. We should be working where it's harder to reach, the markets are harder to reach, or if they're easy to reach markets and we would be getting market rate returns anyway, how are we then working within that space to make sure that the impact is greater than it would have been otherwise? So, and impact-linked finance addresses this from both perspectives, in that sometimes there are trade-offs and we need to compensate for them. And that's where having a public or philanthropic funder coming in to make that possible. And there's other times where the enterprises are commercially viable, they're able to attract investing, and there what we're doing there is focusing on pushing them to achieve more impact than they would have otherwise. But I think that if the investment would have happened anyway without an impact investor, then there's not that much of a role for us to play, really. So as impact investors, we need to be seeing how we can push the boundaries.
We need to be very selective in where we choose to invest our capital. If it's a space that private sector would normally go on its own, probably that's not the space we're playing in. And I totally agree with that. Elias reminds us that impact investing is a cross-cutting theme and not a specific asset class. I do want to go to a question here by Mark, who talks about ask, how accessible is this to investors at different parts of the spectrum? Look at across from institutional and what do investment terms normally look like regarding liquidity, time span, and minimum investment contributions?
Sorry, Frank, I lost you for a second there. Who was that question from?
Maxine Gray of Investec.
Maxine Gray, okay. Maxine, so I'm just having a look at your question. How accessible is this to investors at different parts of the spectrum? So it's a good question, Maxine, and I think the way that we originally designed social impact incentives, we had an outcomes funder who was really our sort of key partner, and that was grant or philanthropic funder. And that essentially leveraged the investment from an investor. And so that investor could in theory be anyone. Increasingly, the more of these we do, the more we realize how important it is that the investors have an impact, an aligned impact, have aligned impact goals, and that they're bought in. Individual investors, always a very tricky thing, but in principle, this model could work with any kind of investors. To your question of what does investment terms normally look like regarding liquidity, time span, and minimum investment contributions, it absolutely depends on the structure. So impact-linked finance can be used across almost all different asset classes. We have the sync model, which is a very simple, it's just an additional revenue stream that goes along with an investment. When the outcomes are created, a payment is released, and it's a very simple structure. And then we've got impact-linked loans, which tie the interest rate to the social outcomes that are created, but we can do an impact-linked revenue share agreement. We can do all sorts of impact-linked types of structures. We can tie a social impact incentive to an equity deal. So it really, there's really no one gold standard in terms of liquidity, time span, minimum investment contributions. What we do find is that the incentive amount needs to be, when you ask about minimum investment contributions, the incentive amount does need to be significant enough to leverage the amount of investment that's going to happen at these deal sizes. And we tend to work with enterprises who are ready to scale. And part of this is because this is the point at which their inflection point of their business plan. And if they can incorporate impact here, not only will it scale as they scale, will the impact scale as they scale, but it'll also bake in the way they think about their business model to include impact. So we kind of start with that as a starting point of where is the right point to work with the businesses as they're about to scale, and then work backwards from that in terms of deal sizes.
Great. A lot of these models that we're doing, Natasha, you'll admit we're very much at the early stages of really rolling out a new approach to how we mobilize and deploy capital for impact across the world. Are we seeing some places where, and I'm tying this to Visa's Constance question around, are we seeing places where some of what we're doing is influencing and driving systemic change, where the proof of concept from some of these models that are being applied are actually going on to influence how, at a much more macro level, things are done and how they're structured?
Such a nice question. I think that, yeah, it's a really nice question, Visa, in terms of systems change and how we do this at scale. I think that there is a lot of thinking around innovative finance in general that has influenced the way that governments are and broad scale programs are running. And I think we've seen this happen with social impact bonds and development impact bonds, governments getting involved. We've seen outcomes funding expand. I do think there's still a long way to go, and I think that governments tend to need a lot of proof of concept, proof of lots of concepts not lots of concepts, but they need to see it happen time and time again before governments come on board. And it tends to be quite a slow process. Having said that, particularly in Africa, we have seen governments get on board with innovative financial structures like this. I think it just does take time. The other thing that I am also wary of is that scale is a very easy goal to aim for. And obviously that it's very important, but if it comes at the trade-off of understanding the individual transactions needs and working with individual enterprises, we need to be very careful about how we do that. So simply rolling something that works out at scale, like I said, you can have the exact same business in a slightly different context, and you need to pick different metrics and a different incentive structure. So I think it's also really important to keep in mind as we aim for that scale, that we don't do it while trading off on the quality of the impact that we create.
One of the comments you made earlier, Natasha, was around blended finance structures and incentives tend to focus on funders and not enterprises. And can you please speak a bit more to that? And I think it ties in also to Christian's question on the basis of which criteria do you select social enterprises? So if we're only focusing on the funders, or generally the system today to funders over the enterprises, how should we be choosing the enterprise that we support with the various instruments? And is that, so if we can speak a bit to that, and to Christian's question that also asks, is that mainly linked to the themes you mentioned earlier and the ability to scale if possible? Could you describe a few ideal cases?
Sure. So I'll start with the point around blended finance structures, and I've worked on a lot of blended finance structures over the years, and I think that they have massive potential for particularly scalable impacts. But I do acknowledge that when we design them, we usually start with who are the funders who are going to be involved and what are their risk and return expectations. And then how do we design a blended finance structure that meets those needs? And once we've got that working, and we've got a senior tranche that you catalyze the more sort of commercial investors, and we've got a junior tranche where we can bring in the more impact focused investors who have a little bit more flexibility in terms of their return expectations. And then maybe we've got a first loss or a guarantee, or we've got a grant tranche. That's how we would do it. We would look at who the funders were, who were available, who wanted to be involved, and then we design it around what their needs were. And then once we had that all set up, we'd take it to market, and we'd try to find enterprises that fitted that. And to some extent, that's totally fine. But I think the other way of doing it is to say, well, what do enterprises really need, and how do we structure the funding to really focus on what they need? And so it's shifting the way that we approach the market in terms of whose needs do we start with and build from there. To your point, Christian, so on the basis of which criteria do we select social enterprises to support? Because, and I mentioned that impact-linked finance does differ to, for instance, social impact bonds, we are really looking at enterprises that are high impact but also ready to scale. So we're not focusing as much on the nonprofit organizations. We're looking at enterprises that have high scalable potential. We're looking at ones that have some experience in measuring their impact, or are able to, with some support, measure their impact, because that's going to be critical to the transaction. And then we're looking predominantly at how this transaction is going to be additional to what they're doing. And we see that in two main ways. For some enterprises, imagine a very high impact organization that is reaching the lowest income, hardest to reach people, and doing really amazing impact work, but they're struggling to access capital. There we see the additionality being, we can provide them with an additional revenue stream that's going to allow them to access capital. So we see that as more a financial additionality side. On the other hand, we've worked with enterprises who have a very good commercial model, and they are in a very good position that they could be very impactful. But having an impact-linked finance transaction really helps them focus their business model on orienting towards impact. So they're not struggling so much to access capital, but with the additional support and incentives of impact-linked finance are then able to focus more on reaching, whether it's lower income, whether it's better social outcomes, whether it's more women. So there's those are the kind of two big ways that we look at that when selecting social enterprises.
Thank
and
you.
then, sorry, there was even more to your question, Christian. Oh, and I see you here.
Yeah, thank you very much. I think you pretty much answered it, because I was also asking about an ideal case, so to speak.
Yes.
So my understanding is so far you've been coming from the side of structuring and needs of the investors, and now you've been starting to venture into the field of let's find some probable targets and see what they need and then structure it out. Is that the correct understanding?
Yeah, so when I talk about that, I talk about that's more my personal journey. I joined Roots of Impact about 9 months to a year ago, and joined for this reason, because before then a lot of the structuring that I was doing was focused on the funders, and I really think it's so critical that we shift the way we think and focus on the enterprises, and build from a bottom-up perspective in terms of making these instruments work.
Thank you. Very inspirational.
Thanks, Christian.
Yes, and I do want to recognize the work that Joan and her team at UNDP are doing to try and bring standards, because I think, Natasha, one of the things you'll admit that the space also requires standards, so we can be looking at things through a consistent lens. And they're doing some pretty good work around bringing together SDG impact standards for enterprise and equity. And as AVPA, we're trying to see how we can support creating a lot more awareness of some of their work to the broader community. So Joanne, we'll keep working with you on that particular aspect of things. So I think it's pretty exciting, some of the work that's being done on the content to enhance this. I kind of want to, Natasha, for you, just as you wrap your head around some closing remarks, I do want to talk a bit to the question of policy, because all of this has to happen within a policy context. Some adjustments have to be made to the policy and regulatory environment to allow different players to come into this new innovative space and play different roles. So we're very fortunate to have one of the heads of the National Advisory Boards for Impact Investing in Africa. So this body is called NABs on the continent, the National Advisory Boards for Impact Investing, which are really the core bodies driving impact investing on the continent. And Africa has 5, you would say, impact NABs on the continent. There's South Africa, Ghana, Nigeria, Kenya is almost being registered, and Zambia. And we're very lucky to have Elias Masilela, who's the head of the Southern African NAB. Elias, do you want to talk a bit about just some of the stuff that you're working on to enhance the space in the context of trying to create the right environment for all these innovative and exciting structures to actually happen and generally grow the impact movement?
Yeah, thanks, Frank. I can share our thoughts. It's a very complex issue to deal with, but I'll probably start with the foundations or the thinking of impact investing. If you think about it, and we do it consistently over the next 20 to 30 years, ideally what we should see is a reduction in the size and the role of government in all the economies that apply impact investing properly. Currently, the average size of government to GDP ranges anything from 25% to 50% of GDP. If we do it properly, it should reduce the role of the state to 10% of GDP. When we get to that point, what is likely to happen is that government will see that its role is actually supposed to focus on policy making, regulation, and providing the right investment environment for business to flourish. And what we have observed is that there isn't a flood of capital into this area, particularly in the African context. because of policy uncertainty and just bad political leadership. Even though private sector would want to jump into the impact space, that is not being supported by what exists in terms of leadership. So there is an important context that we need to paint here, that for us to be able to succeed, we need to make sure that government understands what its role is and deliver as per the expectations of capital. Because if you think about it, the people who are driving impact have already made the decision that they need to invest for the long term. They can't invest with the aim of maximizing profit at all costs. So you need to make sure that you support them in that respect. What that means is that capital or the private sector cannot only worry about what they do when they invest. They also have to get their hands dirty in engaging on policy and policy making. Because if they don't, they end up with the policies that they don't want, and everything comes to a halt. I always say policy is too important to be left to government alone. Thus, the private sector's role is extremely critical. And this was actually underlined by the heads of state when they adopted the SDGs in the UN. If you look at SDG 16 and 17, it's precisely about recognizing the need for a private sector partnership, which has superior capital in terms of human capital, institutional capital, as well as technological capital. And if you have the partnership working right, a lot of the problems that we're faced with will go away. I'm not sure if that answers your question or provides insights into what you want to achieve.
It just tells me I need to find time to actually have a deeper chat with you on that particular subject. But thank you so much.
Thank you.
On this issue. But as you can see, we're a Pan-African community of many people who are figuring out and trying to live with this mantra that Africa deserves better. We need to move forward better. And you're seeing multiple countries from when you saw we walked into this webinar, we're probably over 20 countries represented here. These national advisory boards for impact investing are critical bodies that are helping support the growth of the impact movement. And for today, this is just the beginning of one of the many chats we're going to be having. We'll have a poll before we go, but before we do the poll, Natasha, any closing remarks from your side? Elias, thank you very much for your remarks.
Thanks a lot. Cheers.
Thanks, Frank, and lovely to see you again, Elias. Just a big thank you to Frank, to the rest of the AVPA team. It's always a pleasure to engage with AVPA. You guys are doing fantastic stuff on ecosystem building across the continent. Please feel free to reach out to me if there are any questions that we didn't have a chance to get to. Always keen to talk more about the space. I'm super passionate about it, and I'm just loving to watch the way it's growing. So please do feel free to reach out, and a big thanks to Frank and the rest of the team for having me.
Yeah, Abi and Abu, can you launch a poll? But as we sit here today, there's a lot of exciting stuff coming up. People, please stay close to us. We want to learn from you. We want you to learn from us. We're all learning through the space. So we'll be very grateful if you can continue to engage with us. Please reach out to us. I'll put my email in the chat box. But before you go, can you please just respond to the poll? It won't take you that long a time to do. But thank you to Natasha. Thank you for your time, and thank you everyone for making time. We'll share Natasha's email contacts if she's okay with that when we send out the recording. And yeah, but before you go, kindly please respond to the poll if you don't mind. Thank you. It's only 4 questions. Appreciate it. You'll get the presentation. We'll speak to Natasha and see if it can be made available.